Before we even begin to analyze the specific price action of silver breaking past $93 an ounce, or gold establishing support at $4,600, I want to share a short but critically important story. It is a story about two friends living through this specific economic cycle of the mid-20s. Let us call them John and Mike. 5 years ago, back in 2021, John and Mike were standing on the exact same financial starting line. They held the same job title, earned the exact same salary, and had an identical amount of savings sitting in their local bank accounts. On paper, they were twins. They both had dreams of early retirement. They both wanted to build a safety net for their families. But as we look at them now, in the early months of 2026, their lives have diverged into two completely separate realities. John is living in a state of chronic, low-level anxiety. He wakes up every morning with a tightness in his chest, terrified of checking his banking app. He works harder than he ever has in his life, putting in 50, 60 hours a week, missing his children's weekend soccer games, yet he feels like he is running on a treadmill that is slowly accelerating backwards. No matter how fast he sprints, the ground beneath him moves faster. When he walks into a grocery store, he hesitates before putting a package of beef in his cart because the price tag makes his stomach churn. He stares at the cost of eggs and wonders when basic nutrition became a luxury item. He fills his gas tank only halfway because a full tank would ruin his weekly budget. He is drowning in what feels like a fake economy, an economy that the news says is booming, but his wallet says is busting. Mike, on the other hand, is calm. He sleeps soundly through the night. He still works, he still contributes to society, but he does not carry the crushing weight of the world on his shoulders. When he logs into his brokerage account, he sees green. He sees his net worth expanding at a rate that outpaces his daily expenses. He feels secure. He feels free. He looks at the same high prices at the grocery store, and while he notices the inflation, it does not frighten him because his purchasing power has grown faster than the cost of living. What was the difference? Was Mike smarter? Did he have a higher IQ? Did he win the lottery? Did he inherit a fortune from a distant wealthy relative? No, none of that is true. The difference was a single, simple decision made years ago. A decision that seemed insignificant at the time, but compounded into a life-changing divergence. John decided to save his life energy in cash. He trusted the currency. He trusted the government to protect the value of his labor. He believed the old adage that cash is king. Mike, however, decided to save his life energy in assets. He trusted the mathematics. He trusted history. He realized that in a world of infinite money printing, holding finite assets was the only lifeboat that would float. Today, in this deep dive analysis, I am not just giving you a market update. I am handing you the exact map that Mike used. Because right now, the gap between John and Mike is widening at a terrifying speed. And if you are still standing on John's path, holding on to fiat currency that is melting like an ice cube in the hot summer sun, you need to jump over to Mike's path immediately. The train is leaving the station. Let us make sure you are on it. I want to officially timestamp this analysis so we are grounded in the facts. I am recording this specifically on January 20th, 2026. As of this specific date, the spot price of silver has confirmed a breakout above $93 an ounce. Gold is trading firmly around $4,670. Why am I being so specific about the date? Because in a hyper-volatile market, context is everything. If you are watching this video in February or May or even late in the year, the price on your screen might be $110, or it might have corrected back to $85. The specific number on the ticker is less important than the structural trend we are documenting right now. The fact that silver sits at $93 in mid-January is a historical signal. Just days before I sat down to record this, the price was $71. The velocity of that move, a $22 jump in a matter of days, tells us that the dam has broken. This is not normal market behavior. This is crisis behavior. This is the market signaling a loss of faith in the sovereign bond market. So, whether the price is higher or lower when you watch this, the lesson remains the same. The velocity of money is accelerating, and the purchasing power of the dollar is collapsing against real things. Let us address the elephant in the room. The comment I see most often in our community, the feeling that gnaws at you when you try to budget for the month. You write to me saying, Brian, this feels fake. The stock market is at an all-time high, but my neighborhood looks like a ghost town. My rent is up 30%, but my boss says there is no budget for raises. Small businesses are closing up shop, yet the S&P 500 is making new highs every week. How can the economy be booming if I am broke? This is the most important concept you will learn today. It is called the Cantillon effect, named after the 18th century economist Richard Cantillon, but I will explain it simply as the swimming pool theory. This analogy will change how you see the world forever. Imagine the entire economy is a giant swimming pool. You, me, your neighbors, the local bakery, the teachers, the firefighters, we are all swimming at the deep end. The banks, the hedge funds, the government, and the giant multinational corporations, they are swimming at the shallow end, right next to the water hose. The Federal Reserve turns on the hose. This water represents liquidity, the printed money. Now, ask yourself, where does the water go first? Does it instantly spread evenly to every inch of the pool? No. It pours into the shallow end first. The people standing there, the banks and the insiders, they get the fresh water first. They get the money before prices have risen. They use this new, cheap money to buy stocks, bonds, gold, and silver. They buy assets at yesterday's prices. The water level rises for them immediately. They feel rich. They feel the boom. They pop the champagne. But by the time that water, that money, ripples all the way across the pool to where you are swimming in the deep end, two things have happened. First, the prices of everything have already gone up because the rich people bid them up. The house you wanted? A hedge fund bought it? The stocks you wanted? The banks bought them? Second, the water is diluted. Your dollar buys less. The $60,000 you earn is still $60,000, but it now buys what $40,000 used to buy. So, we have a K-shaped recovery. Picture the letter K. The top arm of the letter K goes up. That represents asset owners. That represents people who own homes, stocks, gold, and silver. The inflation pushes their net worth up because their assets are repricing higher in dollar terms. The bottom arm of the letter K goes down. That represents wage earners. That represents people who work for money and save in cash. The inflation pushes their purchasing power down. We are seeing a massive disconnection because the mechanism of wealth has shifted. In the old world, the world our parents lived in, you got rich by working hard, saving 10%, and being prudent. In this new world of 2026, you get rich by owning assets that inflate. Hard work is still important, but hard work without assets is a trap. It is unfair. It is cruel. It makes you angry. It should make you angry. But getting angry will not fix your bank account. Understanding the rules will. You have to move from the bottom of the K to the top of the K. You have to move from being a wage earner to being an asset owner. Even if you only have a little bit of money, you must position yourself where the water is flowing. You must stand near the hose. Now, let us get technical for a moment, but I promise to keep it simple. Why is this happening right now in early 2026? Why did silver suddenly wake up from its slumber and sprint to $93? It is because the Federal Reserve blinked. For 2 years, they told us they would fight inflation. They raised interest rates. They talked tough. They acted like the strict parent taking away the punch bowl. But then, something fundamental broke. The US national debt just broke past $38 trillion. Think about that number. 38 trillion. It has grown by $2 trillion in just the last year alone. But the scarier number is the interest. The annual interest payment on this debt has officially hit $1 trillion. Let me put that $1 trillion into perspective for you. That is more than the United States spends on its entire military. It is more than the budget for Medicare. We are now spending more just to service our past mistakes than we are on our national security or our health. The government cannot afford to pay that with tax receipts alone. They are trapped. They have two choices, and only two choices. Choice A is to default on the debt. Tell the world, sorry China, sorry Japan, sorry American pensioners, we cannot pay you back. This would destroy the global financial system instantly. It would be a depression worse than 1929. Choice B is to print the money to pay the bill, to create new dollars out of thin air to pay the old debts. They chose choice B. They always choose choice B. History tells us that every fiat currency regime eventually chooses inflation over default, but they cannot call it printing money because that scares people. That sounds like the Weimar Republic. That sounds like Zimbabwe. They cannot call it quantitative easing because that sounds like an emergency measure. So they use subtle language. They talk about balance sheet normalization or liquidity provisions. But look at the data. The balance sheet has stopped shrinking. The liquidity is finding its way back into the system. The markets are not stupid. The algorithms are not stupid. Gold knows what that is. Silver knows what that is. Bitcoin knows what that is. It is fresh money. It is dilution. It is the green light to buy hard assets. And here is the kicker, the final piece of the puzzle. It is an election year. Do you really think the administration in power is going to let the stock market crash or the economy stall before November? Absolutely not. Political survival is the strongest force in Washington. They will ensure there is enough liquidity to keep the illusion of prosperity alive. They will make sure voters feel rich when they look at their 401ks. They need the stock market up. They need unemployment optically low. This is why I say, and I will repeat it until I lose my voice, do not fight the Fed. If the Fed is providing liquidity, the value of the dollar must go down. If the value of the dollar goes down, the price of silver must go up. It is not speculation. It is mechanics. It is gravity. Silver at $93 is simply the market adjusting to the new supply of dollars. And since they are not stopping the deficit spending, the adjustment is not over. The price has not yet found its equilibrium. So, let us look at the assets. Let us look at the lifeboats. We need to build you a portfolio that can survive this flood. We start with silver. Why is silver the star of the show right now? Why is everyone talking about the white metal? Silver is unique because it is a dual threat. It is two things at once. First, it is a monetary metal. It has been money for 5,000 years. It is mentioned in the Bible. It was the currency of Rome. When people lose faith in paper currency, when they see their grocery bills doubling, they instinctively look for something real. They buy silver coins. That is the investment demand. That is what we are seeing with the price jumping to $93. People are panic buying protection. But second, and this is crucial, silver is an industrial necessity. You cannot have the modern world without silver. You cannot have the green energy revolution without silver. Solar panels use massive amounts of silver paste. You cannot have the electric vehicle revolution without silver. Every EV has silver in its connections, its batteries, its management systems. You cannot have the AI revolution without silver. The chips, the servers, the electronics, they all need silver because it is the best conductor of electricity on the periodic table. Better than copper, better than gold. We have been running a supply deficit for years. We consume more silver than we mine from the earth. Above ground stocks were already low. The warehouses were draining. Now, add the monetary panic. You have investors fighting with Apple and Tesla and Samsung for the same limited pile of silver bars. This is a recipe for a silver squeeze. When the price broke $50, the shorts panicked. These were the banks that bet against silver. They had to cover their positions, which means they had to buy, driving the price higher. When it broke $70, the industry panicked. The solar panel manufacturers realized they might run out of raw materials, so they started hoarding. Now at $93, the public is starting to panic. The average person is waking up. We are approaching $100 an ounce. Psychologically, 3 digits change everything. When people see silver at $100, it makes headlines on every news channel. It becomes a dinner table conversation. That brings in the FOMO, the fear of missing out. Expect extreme volatility. We could see it shoot to $120 and crash back to $90 in the same week. Do not trade this with leverage. You will get wiped out. Buy physical metal. Buy the ETF if you must, but hold it. This is a long-term repricing of a strategic asset. We are witnessing the demonetization of debt and the remonetization of real things. Next, let us talk about gold. If silver is the volatile race car, the speedboat that chops through the waves, gold is the armored tank. Gold is the aircraft carrier. As of today, gold is trading around $4,000. $670. I know that number sounds high. If you remember gold at $2,000 just a few years ago, this feels expensive. It feels like you missed the boat. But you have to stop thinking in terms of nominal dollars. You have to adjust for inflation. Adjusted for the true inflation of the 1970s calculation, gold is arguably still cheap. But the bullish case for gold is not about you or me. It is not about jewelry, it is about the whales. The central banks of the world are buying gold at a record pace. This is the most underreported story in finance. China is dumping US treasuries. They are selling American debt and using that money to buy gold. Russia is doing it. India is doing it. Poland, Singapore, Turkey, they are all stacking bars. Why? Ask yourself why. Because they see the US debt. They see the $38 trillion. They know the mathematics better than anyone. They know the US has to print money to survive. They do not want to hold an asset, the dollar, that is guaranteed to lose value. They want an asset that has no counterparty risk, an asset that does not rely on a promise from a politician. When the central bank of the world's second largest economy is aggressively buying something, you should pay attention. You should copy their trade. Gold is your insurance policy. It is the anchor of your portfolio. When the stock market shakes, gold stands firm. When the currency collapses, gold shines. I recommend every portfolio have a core position in gold. It is not there to make you rich overnight. It is there to make sure you stay rich when everything else burns. It is the foundation upon which you build your house. Now, we have to talk about the third asset. The one that makes traditional investors uncomfortable. The one that causes arguments at Thanksgiving dinner. But it is also the one that is making the new generation wealthy. Bitcoin. I know some of you are skeptics. I read the comments. You say it has no intrinsic value. You say it is just digital air. You say it is a Ponzi scheme. I hear you. I understand your hesitation. But I look at the data. I am a slave to the data, and the data says that Bitcoin is the fastest horse in the race against debasement. Bitcoin is purely a play on liquidity. It is a liquidity gauge. When the Fed tightens, when they pull money out of the system, Bitcoin crashes. We saw that in 2022. It was brutal. But when the liquidity returns, Bitcoin acts like a sponge. It soaks up that liquidity faster and more efficiently than real estate or stocks. In 2026, Bitcoin is different. With institutional ETFs, with sovereign wealth funds getting involved, with major banks offering custody, Bitcoin has matured. It is no longer just magic internet money used by geeks. It is digital gold for the digital age. It serves the same function as gold. It cannot be printed by a government. There will only ever be 21 million coins. No one can dilute your holdings. The Fed can print trillions of dollars. They can print to infinity. They cannot print one single Bitcoin. That scarcity, combined with the flood of fiat money, is what drives the price. If you can handle the volatility, and let me be clear, it is wild. A small allocation to Bitcoin can act as rocket fuel for your portfolio. It will crash 30%. It will rip up 100%. It is the asymmetric bet. If you lose a little. If you win a lot. Now, I want to speak directly to the person who feels left behind. I want to look you in the eye. Maybe you are listening to this and thinking, Brian, this is all great for rich people. This is great for people with surplus capital, but I have $500 to my name. I have credit card debt. I live paycheck to paycheck. How can I buy gold at $4,000? How can I buy Bitcoin? I am just trying to survive the week. I want you to listen to me very carefully. You are the person who needs this message the most. The rich can afford to make mistakes. They have a cushion. You cannot. Inflation hurts the poor the most. It is a tax on the poor. It destroys the purchasing power of your wages before you even get to spend them. So, doing nothing is not an option. Hiding your head in the sand is not an option. Saving your way out of this is mathematically impossible. You cannot save fast enough to beat 10% true inflation. So here is your battle plan, the little guy strategy. I want you to follow this religiously. Rule number 1, change your unit of account. Stop measuring your wealth in dollars. Stop looking at the number on the paper, measure it in ounces and satoshis, measure it in purchasing power. Rule number 2, fractionalize. The financial system has changed. You do not need to buy a whole ounce of gold. You do not need a whole Bitcoin. We live in the era of fractional investing. Can you save $50 this week? Just $50. Do not put it in the bank. Do not let it sit there. Buy $50 worth of a silver ETF like SLV, or better yet, a physical silver coin if you can find one at a local shop. Buy $50 of a gold ETF like GLD. Buy $50 of Bitcoin on an exchange. Buy $50 of a fractional share of the S&P 500. You might say, but Brian, $50 won't make me rich. You are right. $50 will not make you rich. But that is not the point. The point is not about getting rich tomorrow. It is about building the habit of accumulation. It is about psychological rewiring. It is about changing your identity from a consumer to an investor. When you own an asset, even a small one, you stop being a victim of inflation and start being a beneficiary of it. When silver goes to $100, your $50 grows. You feel a win. You feel a dopamine hit. That win motivates you to find another $50. Maybe you cancel a Netflix subscription. Maybe you cook at home one more night instead of ordering Uber Eats. You start scavenging for capital to feed your asset column. You become addicted to freedom instead of consumption. That is how you break the cycle. That is how John becomes Mike. It starts with the first $50. It starts with the first decision. Do not despise the day of small beginnings. Every empire started with a single brick. Lay your first brick today. Finally, let us look at the road ahead. What comes next? We are in January. The momentum is strong. The bulls are in control. But markets do not go up in a straight line forever. I want to prepare you for the turbulence. I want you to mark May 2026 on your mental calendar. Why May? Because by May, the initial rush of this liquidity injection will likely be absorbed. The sugar high will wear off. The inflation numbers will start to look ugly again. The media will start screaming about the return of inflation. The Fed might have to pause. They might have to talk tough again to calm the bond market. We might see a correction. Silver might pull back from its highs. Gold might dip. Bitcoin might crash 20%. When that happens, and it will happen, I want you to be ready. Do not sell in panic. Do not let them shake you out. Recognize it for what it is, a buying opportunity, a gift. Because remember the macro picture. Zoom out. It is an election year. They cannot let the system fail. If they pause in May, they will pivot back to printing by July. The trajectory is set. The debt demands it. The system requires constant liquidity to function. They have crossed the Rubicon. There is no going back to sound money without a total collapse, and they will print every last dollar to prevent that collapse. I will be here with you every step of the way. I am watching these charts 18 hours a day so you do not have to. When the sentiment shifts, when the fake news tries to scare you out of your positions, I will be here to remind you of the math. I will be here to remind you of John and Mike. If you want to know exactly when I am buying, when I am selling, and how I am navigating these choppy waters in real time, I invite you to join our private community on Patreon. That is where we go even deeper, where I share my personal portfolio moves the moment I make them. The link is right below. But whether you join or not, please take action on what you learned today. Do not be John, be Mike. Get off the sinking ship of cash. Get on the life raft of assets. The water is rising. The pool is flooding. Start swimming. I am Brian from Fingraphy. Stay safe, stay invested, and never ever fight the Fed.